Welcome to the very first episode of the Money Plant podcast. To get things kicked off, we're joined by a very special guest, and our discussion is around the ever-shifting financial landscape in New Zealand. The advice that may have worked for our parents or past generations may no longer work for us today or future generations. And in saying that, advice that might work for us today might not work for us by the time we reach retirement. So how do we kind of adjust our portfolios around that? Today we're joined by Darcy Ungaro, the host of the very popular Everyday Investor podcast of Radical Investment. I hope you enjoy. Darcy, welcome. Thank you so much for joining me today. It's very exciting to have you here. Thank you for the time.
Thanks for having me, man.
No worries. So tell us a little bit about yourself, your background, your work, and your kind of philosophy around finance and how that shapes the advice that you give.
Sure. So forgive me if I go off track. You'll have to pull me back, right? So background, I'm from Canada originally, 1994, moved here permanently, went to university, ultimately started a business which was a mortgage advice business, scaled that up, added insurance, added KiwiSaver, added fee paid financial coaching services, sold that off, and then bought into a new business which is focused on custom making KiwiSaver portfolios and investment portfolios as well. And again, financial coaching. Started off a podcast 8.5 years ago, The Everyday Investor. Still doing that weekly show today. And a lot of what forms the advice that I give my own clients when I'm meeting with them comes from a mixture of the clients that I previously caught up with and the conversations that I have often on the podcast, which is like probably a third of the reason why I do it is just for ongoing professional development. But the conversations that you have before and after, kind of like what we did before we hit record here, is where you really get a lot of insights as to what's actually happening. I think sometimes it's not something that you would release to the wild, not because it's so precious, but just because it's so specific to how you're building your business and seeing the world, right?
Yeah, I get you.
But so a lot of the everyday conversations with everyday clients and the people that I'm talking to on the podcast, that's really what fundamentally shapes my advice that I give.
Okay, so a lot of behind the scenes, like you said, your own development really, and you can get something out of that, and from there you can shape it for how you present it to clients as well. Awesome. Now you've been doing it for quite a while. You've been, I believe it's over 2 decades that you've been in the space, right?
Which never felt like a long time. I remember when I first started hearing people say, you should always choose an advisor with experience, right? But you can't believe that when you're starting out because you don't have any experience, right? And I think experience is important, but it doesn't necessarily have to be your own.
Yeah, you can pull from a lot of case studies. I fully agree, but it has kind of helped shape my own experience because I resonate better with certain areas of advice, right? So I specialize in insurance and KiwiSaver, but something I've been going through the last year is budgeting and getting control of finances, switching jobs, getting into the industry, commission-based role. So generally you take a bit of a pay cut, right? So, and there's a bit of a way to go before you actually start getting some income. So I started focusing a lot on budgeting, and that's when I realized there's not that many, let's say, advisors out there, same as much that would be in the KiwiSaver space or insurance space or the mortgage space, right? It's not as profitable of a service that people offer, but it's an incredibly beneficial service to offer. So I've kind of shifted my focus or my philosophy around how I'm giving advice to match my own experience, which is to introduce a bit of budgeting advice and kind of some basic money tips. So,
and you're going through that right now.
That's exactly what I'm going
through. Which is great. You can't give away something that you don't have.
Exactly.
Otherwise, it's just not authentic. You're just a salesperson. And sadly, I think with a lot of financial advice models, we are distribution networks, right? We're part of a distribution network to get that financial product out there, which is regulated by the FMA. And so it becomes very product or solution focused rather than actually financial advice. Which is what people are coming to us for.
Yes, it can, but there are models as well, and I believe yours as well, right? You've got a fee-based model as well, which kind of completely does kind of shift the focus from a commission-orientated advice process to this is what you're paying for up front, and you're going to get all the right things regardless. It's a great way to go.
And like my philosophy, and it's been like this for a while, 100% no commission, no referral fees, no kickbacks, no nothing. Not because it's bad, but like for a lot of people, you need to seek advice from someone who's getting a commission. Otherwise, you wouldn't be able to afford what they're doing. But because it's quite transparent, and we're living in a world where everything is shifting.
Yeah.
And the best way to adapt to it, in my view, and this is true from a business owner, but also from a consumer of financial advice, is to be resilient and to actually be independent and to build your own business in this space, which isn't dependent on partnering with a bank, for example, who can change their commission model, or for an insurance company who gets a new bit of legislation that they have to adapt to, and now you're paying the price as the distributor.
Okay.
So I've learned a lot of that over those 2 decades. Just seeing how my advice that I have to give to clients has to change for these commercial realities. And so about 8 years ago or so, when I started doing the podcast and I started getting more clients reaching out to me for general advice, like general financial advice, I had to adapt, and I had to build a model that was commercially viable, that people were willing to pay for, which was okay from a regulatory standpoint, and I was comfortable doing. And it just means that, they have to pay for it. And ultimately, what I found is that people, when they pay for it, they take it a lot more seriously anyway. Who knew? And the outcomes that people started to get, in my view, started to really genuinely improve, because I was helping them make better decisions that they were more than capable of making on their own. They felt empowered, they felt good, they felt confident, and we both went our separate ways. That's actually good. Rather than flogging a product, getting paid a residual commission from a provider, and then being forgotten about anyway, and then feeling guilty that you haven't added any value. That's actually how a lot of advisors work, let's be honest, right?
Unfortunately, I think it is quite flooded with that, because it is a way, if you get in front of a lot of people quickly, you can get a lot of commission quickly, but then the whole intention is wrong, unfortunately. But though there's a lot of places that I've seen as well that are starting to introduce a bit of a hybrid model in terms of some of it's commission, some of it's a fee-based one. One that I've been chatting to, they do a monthly payment as well. Because one of the things I find with the fixed fee model is the barrier to entry, right? It can be a relatively expensive entry point. And I think that's probably one reason why I haven't really kind of gone down that route yet, just because of that. I feel this might be a little bit harder, maybe especially where we're located. And we're working with a lot of first-home buyers as well, and adding in another expense. But have you found any issues with that, or kind of ways around it? Or
Well, so within my new business, Radical Investment, there's other options where there's an ongoing fee model, if you want ongoing accountability and more long-term financial planning and goal setting and keeping you accountable. And then there's financial coaching, which is a one-off upfront fee, but it's strictly not financial advice because there's no product talk. It's very high level, very strategic. That works for a certain type of person. And I think that's kind of where the podcast really helps, because I'm speaking to people who genuinely don't want to be sold to, and they just need somebody as a sounding board who kind of understands their world, isn't going to judge them for how they're doing it. And then that's all they really are looking for. But I think there's a model for everyone in terms of the advisor and for the consumer. And it just takes matching those certain advisors with those certain clients. And it takes a bit of tenacity. If you are a consumer or would-be consumer of financial advice, it takes a little bit of tenacity. You have to get out there and shop around a little bit until you find the right one for you. And just being honest that, hey, if it's a commission salesperson who's giving you advice, that's not necessarily bad. That's just how they get paid. Everyone goes to work to get paid. So there's no right or wrong way to get it done.
No. No, being in the industry as long as you have, you would have seen a lot of changes, and especially a lot of the podcast episodes that you put out there. A lot of them are very in depth and they're very technical. So it seems you've got a really good understanding of how things work, how things operate, big picture, and then you have a really great way of kind of applying it to the everyday investor, and kind of relaying that information to someone like me who resonates very well with it. So you take these concepts and you do a really great job at communicating them through. But over the last, say 20 years or so, what are some of the most major shifts that you would have seen take place?
Sure. Yeah, good question. So, and this probably goes back to when I grew up and I had kind of like a rich dad, poor dad sort of situation happening at home, where I kind of learned 2 different models of how to build wealth, but mostly it revolved around property. And if there was surplus income, okay, term deposits. Right? So very simple. And I think
safe.
Simple, safe, not too much moving parts, right? And then over time, I think a lot of people cottoned on that's actually how you get it done. And it created this wave of wealth that accrued into into the property asset class. And which I've benefited from as well. But over time, I think when you get a lot of people flocking into one strategy or one asset class, that opportunity starts to dissipate a little bit.
Yeah.
When you have a lot of people feeding from the same trough,
Yeah,
that
yeah.
kind of makes sense, right? And so as that's happened, and as there's more money that gets created over time and starts to circulate in the economy, the opportunity starts to it dissipates. It's kind of like energy isn't created or destroyed; it just gets transferred. And financial opportunity, I think, is the same way, where it just moves further out on this abstract thing called the risk curve. And the change that I've noticed is that either you're building business or you're early to some idea, concept, or asset class
Okay.
that most people have missed. And unfortunately, it seems to be, and I don't know if this is true or not, that property is reaching a critical kind of fork in the road where
Yeah.
it's like, is this really the way that we're going to do it going forward still?
Yeah.
Or is there something else?
It doesn't seem like it, and I have a similar thought, and maybe it's just coincidence in terms of timing, or there was an underlying need for it, but the rise of Sharesies, obviously New Zealand, has taken off massively. They just crossed 1 million users. It just seems to be a really great time where, yes, there are barriers to entry for property. It has worked, but there is this shift towards Sharesies. I use them. I use Kernel as well. It's literally put investing in our hands. And so are you seeing a bit of a shift with your clients as well, where maybe a conversation has started changing? One of the reasons, as we mentioned just before this, I kind of asked John today, and as I shared before, my family, my father grew up, a property was his go-to. Now this was in a different country, but same concept. Property was the way to go. For my brother and I, he had started a savings account, but those monies that he transferred in over 18 to 20 years was all put in a high yield savings account, term deposit type approach, zero investments. So if I were to go and ask him for some advice, he's going to say property, and him specifically, he's going to say commercial property. But as we've just discussed and realized, it might not be as viable of an option anymore. So kind of how are you seeing that shift? Well, how are your conversations going, and how have they shifted over the last 20 years?
Yeah, that's a great question. And probably, to be honest, the biggest shift happened from March of 2020,
Yes, of
right?
course.
So
Yeah.
when we started to see that, and I don't want to go too technical too quick here, but when we started to see that central banks started to become a lot more influential in our lives.
Yeah, yeah.
They had the power
Yeah.
to make the cost of money, interest rates, really cheap,
Too cheap.
too cheap. And then we observed the impact of that through a booming property market, which really should have crashed after the whole world was locked down.
Yeah,
Everyone
yeah.
would have thought that, right? Same thing with shares. Most people assumed things would crash and everything's just stuffed. But we saw just how influential central banks were and just how serious of an impact things made when they artificially lowered the cost of money.
Yeah.
So that's kind of when I started to really notice the shift, that people started to kind of, not necessarily consciously, but subconsciously picking up the rules of the game. That when things get scary, money gets cheap. And if money gets cheap, assets get expensive.
Yeah.
So if we see that pattern, we wait for the fear.
Yeah.
We buy the assets,
Yeah.
ideally with borrowed money.
Yeah.
We wait, we see a gain. And so that is really easy to work that strategy out through property.
Yes.
If you have a deposit, if you have the income, if you qualify for the mortgage,
Yeah.
you buy a property, ideally a property which is in, not abundant supply,
Yeah.
but
Yeah.
scarce style properties.
Yeah.
You hold, and then later on, if you want, you could sell, repay the debt which hasn't increased,
Yeah.
with the profit on a property that has increased.
Yeah.
And that kind of rinse repeat cycle is something that I think a lot of everyday New Zealanders can play that game.
Yes.
As long as they have income and
Yeah.
they've got their personal finance
Yeah.
under control. And that's where a lot of the great work that mortgage advisors do
Yeah.
can really help them to build wealth using property.
Yeah.
But that's what I would call a 1.0 strategy,
Yeah.
on a broader strategy called the debasement trade. And that's a trade, or that's a concept which just benefits from how the system works. And by
Yeah.
the system, I mean the banking system.
Yeah.
And how scarce assets respond to a banking system which is expanding
Yeah.
its influence. There's other ways, though, that you can play that trade. And I think that's what we're starting to see. Sharesies was a great example of how They reduce the barrier to entry by fractionalizing the opportunity.
Yes. Yeah.
We're seeing some really cool initiatives come out at the moment with fractionalizing property ownership. And then in the digital asset space, fractionalizing units of ownership into something. Well, that's normal. That's just kind of what you do. It's wired into it. So the asset classes or the different things, whether it's property, shares, business, crypto, or other things, precious metals, those things are what they are, but they respond to changes at the system level.
Yeah.
And it creates a pattern. You follow the pattern, you grow wealth.
Could you go into that a little bit more around the debasement part of it and how it works for property, but these asset classes are what they are? How does that same concept apply to these asset classes?
Great question. And this is the hard part, right? You mentioned this before, Kyle, which I thought was good. One of the hardest part of what I do is try to take these complex things and make it accessible for everyday people. So forgive me if this isn't accessible. It's the hardest part. I really try. And sometimes it's hard to communicate this simply. But what I found is that a lot of people do understand it eventually. It's kind of like coats of paint. You got to go over it and over it. Eventually it makes sense. But since 1971, I'll start there.
Gold standard,
gold standard, right? So we had Richard Nixon took the US dollar fully off the gold standard. Prior to that, every currency in the world could be traded with the US dollar, and the US dollar was redeemable for gold, which really only came out of the earth at a rate of around 2% a year.
Inflation,
which is kind of coincidental. That's what the inflation rate has been targeted as. So when the US dollar was no longer anchored into that finite amount of gold that was coming online, it was then possible for governments and central banks to work together in tandem to create scenarios and environments where people could access more money. So governments, corporates, and individuals like you and me have been able to borrow money from banks a lot easier since then. And every time we borrow money, what we're doing is we are bringing into the world or bringing into the economy new units of money, new currency, because of how the banking system works.
They're creating it. So every time someone takes out a mortgage, essentially, if I understand this correctly, they're creating that borrowing.
Correct. Yeah, they're creating, and borrowing is a good word for it, because money is actually debt, which is a weird concept, and it took me a long time to get this. But when you see a dollar in your bank account, it's an asset, but it's also a liability. And it was actually put into there. The bank created it and put it there, and it genuinely did not exist before. A lot of our understanding, especially with what you might learn in school, would be that it's more like a fractional banking system where the banks are able to lend, but they have to have some assets, or it's effectively they're taking money from savers and they're transferring it to the borrowers.
But there was something backing up what they were borrowing, similar to casinos, right, where they ideally have the cash reserves to be able to support all the chips they have out on the tables.
But now it's a little less clear what's actually going on, and they are regulated, they're controlled. That's what the function of the central bank is. But that money genuinely didn't exist before. And over time, we think about inflation, like CPI, also known as CPI, 2 to 3% a year, which measures the changing price in a pre-selected basket of goods, which hardly any of us actually buy. And what really occurs is that we have about 7%, 7 to 8%, depending on who you talk to, is the rate at which new currency comes on the scene by. In other words, we have new dollars, and every time they're created, some dollars get deleted when people repay debt. But when through the act of borrowing over time on net, you get a net increase in the supply of dollars, and that dilutes the purchasing power of all the existing dollars that already exist.
And that's the debasement.
And so the next level in is to take the money, which is increasing in supply, and trade it for assets which either don't increase in supply at the same rate, or ideally, in a perfect world, don't increase in supply at all. And that's how the debasement trade works. So precious metals is a great example. They're not absolutely finite. There's always new supply. but the rate at which they're being gobbled up by central banks around the world, and
Yeah.
especially in the last 10 years.
With BRICS especially as well, right?
Yeah, exactly.
Yeah.
That's increasing in a lot of countries like India and China, which account for almost half of the physical gold demand.
Yeah.
They gobble it up.
Yeah.
And then everyday people, they might hold it either as an investment, it's an input for industrial and monetary reasons as well. But the main thing is the reason why it works as an investment is because you can take money, which I know might not feel like it for everyone, is abundant.
Yeah.
And you trade it for something finite.
Yeah.
At a later stage, you sell that something finite for a lot more money.
Yeah. Yeah.
And then it works even better if you can somehow leverage that, or you can borrow the money to trade for scarce assets, and then you service that borrowed debt with income that you bring in until such point as that income stops coming in, and then you close that trade out and go, just like buying a rental property, right?
Yeah.
It's exactly the same thing. It's just instead of using the property as the scarce asset, you're using, say, precious metals.
Yeah. Okay.
Or you're using shares.
Okay.
Or you're using Bitcoin, which
Yeah.
in my view is probably the most pristine form of expression of that debasement trade.
Okay. Why would you view that as the most pristine form?
It's the most transparent way to verify that you're dealing with a scarce asset.
Because of the limited supply, it's only like 100 years or something left, 21 something, right, and 2 million or something more to mine. So because it's finite, and because of, I'm assuming, the blockchain technology behind it, that's transparent. Is that what? Okay.
100%. So, and there's a little, like, not a little bit, there's a lot of detail in this one, right? So I think that as it relates to that debasement trade piece, if you had absolute certainty that you could trade money, also known as fiat currency, which is money created by decree or created by a central bank or a government, if you could trade that money for a scarce asset which can exist outside of the network of banks or outside of the financial system, then you have ultimate security that you won't be caught if there's ever a change to how things work.
Something that's so independent that it's not reliant on whatever happens here, you're still protected over here. Okay.
Which is exactly how our parents' generation and beyond would have thought of property.
Yeah.
Right?
Yeah.
We'll buy a property, we'll take out a mortgage from the bank, we'll get rid of the mortgage, and then
it's
we'll
mine.
be secure. It's mine, right?
Yeah.
Couple of issues with that. Well, first issue is that when you get rid of the debt, if you haven't discharged the mortgage instrument against the title, the bank could still actually go after your home. You'd be surprised. Just read The Great Taking for an example of how that works. Then the trade kind of also morphed, or I guess the first way maybe to say that before I get into the next level would be some people cotton on to the risks present with property earlier on, and they express that through gold and silver, precious metals. And now I think Bitcoin is just the digital version of that same thing. It just took a while for that asset to come into existence, which existed purely in the digital realm. Everything else can be represented in the digital realm, but there's been no genuine scarce asset that's ever existed that's existed in the digital realm.
So it's like the technology, right? And also I think like similar to Pokemon cards nowadays, outside of the money laundering conspiracies around it. But one thing they always say is that I grew up with Pokemon being a child. Now I've got money to spend on Pokemon cards, right? I think it also takes some time for, let's say, a generation of thinking to change from property isn't working what it used to be. There's this asset available now. And it needed, I think, some population to be able to actually put money into these new assets to allow it to then grow, and then from there to allow it to expand to what it is today as well. I think it needed a mind shift switch, and I still think it's going through that transition. My wife still is not big on crypto at all, so I do think that it still takes some time to actually shift still. So I think it's got a very long way to go.
I think so, and I think even just the fact that it's viewed as crypto is part of the issue because it's but it is not crypto. You know what I mean? Bitcoin is born out of that asset class. But it's the only one, in my view, which would be an investable crypto. Because it's the only one that has 100% scarcity coded into it. There's no centralized puppet master that's created this digital asset. And we've seen time and time again that every time we go through these cycles, Bitcoin is the only one that stands firm at the end of it, and it
Okay.
just keeps coming back.
Yeah.
The other ones pop every now and then, but
Yeah.
then they go away. And that says a lot about if you were to hold a digital asset, which one should it be? It should
Yeah.
probably be the one that you have the most confidence in.
Yeah.
Like a lot of the KiwiSaver portfolios that we build or investment portfolios will have an allocation to Bitcoin in it,
Yeah.
as well as precious metals, just by default.
Yeah.
Obviously, we can take it out for people if they don't like that. But the reason why we do that is because we genuinely believe that at the very least, Bitcoin and gold is insurance.
Yeah, okay.
And it's insurance against systemic failure.
Okay. And how are you seeing that play out in practice now in the advice that you're giving, and how that advice would have shifted, right? Because when you started, Bitcoin wouldn't have been around. Property would have been the Hail Mary of any investment back then. How are you seeing that play out now with the advice that you give? What does a standard, let's say, sounding board session or advice that you give look like?
Good question. So the standard session used to be around the property.
Yeah.
And what's our next move into property going to look like?
Yeah.
Should we buy another rental?
Yeah.
What's it going to take for us to sell this place and get into a nicer place?
Yeah.
Irrespective of whether we were talking about the mortgage or not, we were talking about the strategy, and it all centered around property.
Yeah.
Because for most couples, if there's two people in a household making financial decisions,
Yeah.
it's around what they can see and feel,
Yeah.
and both agree has value.
Yeah.
Sure, one party might think value exists in other investments,
Yeah.
and the other party might not be. There's always a blend,
Yeah.
but it's always been about property. So what's changed over, and I've seen this like quite significant change about this time last year. So this time last year, as it relates to say Bitcoin and gold, we're already starting to see the price kind of creep up, but we hadn't yet seen the all-time highs yet.
Yeah. Okay.
Right.
Yeah.
So we were on our way, but we weren't there yet. And we've since come off those all-time highs at the time of recording. But what I was starting to see is a lot of people were coming back to me that I had spoken to 5, 6, 7, or 8 years prior
Yeah.
about, here's what I really think you
Yeah.
should do.
Yeah.
You know, and a lot of my meetings in the past has been 80% helping people with what they want to do, and
Yeah.
then 20% genuinely acting in their best interest by telling them about the future that I saw coming.
Yeah. Okay.
And that's where I sounded like a crazy person. I still do. It's kind of how I roll.
Yeah.
It just so happens that a lot of that crazy has ended up being true.
Yeah.
And so I think in a lot of those couples that I worked with, at least one person remembered that. But funnily enough, it's been, if there was a female and a male, it was the females. This time last year, they all got, I have no idea what happened, but the penny dropped. I was like, cool, we got to get in contact with that guy that I thought was crazy, and we got to find out, how do we get Bitcoin? And so that's kind of been a lot of the conversations,
Yeah.
is just helping people figure out, should you hold Bitcoin in your own wallet? Is that safe? Can you comfortably do that? How are you going to pass it on to your partner or your kids when you're gone?
Yeah.
Or do we put this in, say, a managed fund inside of a portfolio?
Yeah.
Or inside your KiwiSaver, pros and cons, tax, custody risk, which way should you go?
Yeah.
Maybe a bit of both. That's kind of been like practically how those coaching sessions have gone, is
Okay.
from hearing a crazy guy talk about the future to how can we get some of this future now before everyone else figures this out?
Yeah. And how do you, again, further into the practice, you've got a unique KiwiSaver way, right? You use your Kiwi wrap and you kind of build everything from scratch, which is great. You can really customize it. What does that process look like? How am I getting, if I go to you, how am I getting my KiwiSaver to include some Bitcoin?
Yeah, it's pretty easy for you from your perspective as the consumer, right?
Yeah.
From our perspective, that there was a few wires to be connected early on when the business was formed.
Yeah.
And the original founder, or the founder who still exists, Joel Robinson, he set up the business a few years back before I bought in.
Yeah.
And he was a Bitcoiner at heart.
Okay.
And he didn't quit until he figured out how to make it work.
Yeah.
And Kiwi Wrap came on the scene roughly around the same time, or a little bit before he started his practice. And the Bitcoin ETFs just were launched only a few years back.
Yeah.
And so basically, if there's an ETF, an exchange traded fund, which holds Bitcoin,
Yeah.
or any ETF, we can generally include that within a KiwiSaver portfolio.
Okay.
So KiwiWrap has minimum amounts. You have to have at least $50,000. But if you do, then, and if you're working with an advisor who will work with you at that level,
Yeah.
then you can get a bespoke, tailor-made portfolio, which effectively comes in a KiwiSaver wrapper.
Okay.
And it allows the advisor to construct that portfolio
Yeah.
from scratch.
Okay.
We have model portfolios, which we would start with,
Yeah.
and then we augment it based on the client's individual circumstances. So if
Okay.
there's a property investor, we generally will dial down the property exposure.
Yeah.
If they want to express the debasement trade more strongly, or if they have a choice that they want to increase their gold, silver, or Bitcoin holdings,
Yeah.
we can increase that.
Oh,
and
okay.
so there's a lot of customization.
Yeah.
You can own just one investment if you want, and it could be just shares in one company.
Yeah.
Or you could have multiple. You can be well diversified, just like any scheme.
Yeah.
Or you can be quite concentrated. And so instead of being an investment, which is kind of like a bit on the side, which you're not taking seriously because it's kind of boring,
Yeah.
you now have choice to exercise.
Yeah.
And therefore make KiwiSaver a core part
Yeah.
of your wealth building strategy.
Yeah. If there's a greater level of involvement from the consumer side, right, and they know exactly how it's come, and then it resonates so well with them that this is exactly what they've invested in. Because I do see it often with clients, since as KiwiSaver still unfortunately isn't treated as seriously as I feel that it should be. It's often the second largest asset that we'll have after the house, but it's so gradual and it's so incremental and it's so long term that not everyone unfortunately can see it that far ahead. But starting, for example, when you've had some clients come back to you from the initial meeting sounding like a crazy person. Now, how do we actually implement this? Where do you see that next change going, right? So again, property would have worked. Now, crypto is working at the moment. What do you think's next? And how do you kind of incorporate what you think the future might be holding or the next big shift might be holding into today's advice to get the benefit today or get the benefit in 20 years from advice that you've given today?
Yeah. So I think an 80-20 rule is a really good benchmark here. Like 80% of what we do, 80% of how we invest or even think for that matter, should be based on best practice.
Okay.
Right?
Yeah. Like, what we know.
This is what we know. This is what's always worked. This feels normal, right? And then that 20% might be a really cautious, deliberate, but well thought out way to get some of the future, the best type of future you can get.
Okay.
Now, sometimes that future might be the past.
Yeah. Okay.
Right. Like a lot of the clients that I was working with, say 6 months ago, were a lot of the forward thinking ones were thinking about global conflict and how that could be expressed in an investment strategy. So commodities, oil, energy, food supply.
Okay.
Those types of things were starting to be requested a lot more.
Okay.
And that shifted a little bit. There was also a strong allocation towards, say, semiconductors and AI themed investments, power generation that goes along with AI or cooling systems or data centers. And then the digital assets, like that comes and goes.
Yeah.
And I think what happens from here is always probably going to be a mix of like a contrarian play on things from the past that keep on coming back in cycles, plus elements of the future. So again, 80-20, in the 20, you have some of the old, some of the new still in there.
Yeah.
But you apply different thinking there, not just different assets.
Oh, okay.
And I think this is the hard part that a lot of us get stuck on.
Yeah.
Because I was thinking about that this morning. It's kind of like Coke and Pepsi, right?
Okay.
You know, like we've got the original, and then we have the copy.
Yeah.
And it's really easy to copy. Something that already exists.
Yeah.
You just change it, make it cheaper, and change the logo.
Yeah.
It's
Change
fine.
the color, logo, and you're good to go. Yeah.
Yeah. And I think that whole Coke and Pepsi thinking, we all like to think that we're original.
Yeah.
But in reality, we're all jumping on the same social media platform.
Yeah.
Subject to our political bias. It's whatever it is. And we surround ourselves by the people that we surround ourselves by. And we might have our own opinion, but really, is it your own opinion?
Yeah.
Or are you just Pepsi fine?
Yeah.
You know, how you think. Because I think if we're really honest, a lot of it is really just what everybody else is thinking.
Yeah, and it's there's a hype that it's easy to jump on, right? You get a lot of
Boom.
whatever it is, but yes, you get a lot of immediate, let's say, gratification by jumping on the hype and joining a conversation, and then your thoughts are then reinforced because you've got a community of people reinforcing your thoughts as well. Yeah,
And you see that in the investment space a lot.
yeah, yeah,
Where people are playing these themes, but
Yeah.
they're getting on, arguably, they're getting on late sometimes. And
Yeah.
I'm not saying that with like right now, but I remember noticing this it would have been 2020, when a lot of people were shifting their KiwiSaver to a certain provider, won't mention who it was, to get access to a certain fund, which was promoted by a certain individual
Yeah.
who is still quite influential to this day. Again, I'm not saying that this, like, I actually have a lot of respect for this person
Yeah.
and what she says about the future and what's coming.
Yeah.
But you can be right on the theme and wrong on the investment. And even when you're right on the investment, you might be wrong on the timing.
Oh, okay. Yeah.
Right. And so
Yeah.
when you're going along and you think you're cutting edge and you're playing the next big thing, but everybody else is as well,
Yeah. Yeah.
you're not. And so in this 20%, you genuinely have to have a Coke mentality.
Yeah.
This sounds terrible, doesn't it? You have to be thinking really originally.
Yeah.
And that is hard. That's a
Yes.
hard exercise. I try really hard at doing this.
Yeah.
And it comes across as cheesy. It comes across as all sorts of things.
Yeah.
Which I like when I listen to some of the stuff I say on the podcast, it makes me feel uncomfortable. 'Cause
Yeah.
I know that it sounds cringy sometimes, right? But I'm just genuinely trying to be original
Yeah.
and creative, and I'm trying to think about things differently, because if I can keep thinking like that,
Yeah.
I'm training my brain to recognize bits of the future that are real and bits of the future that aren't real.
Okay.
I want to collect the elements of the future that are real, and I want to include that in 20% of my portfolio.
Yeah.
And so the way we think and partition our mind between, say, 80-20 is the way that we express that when we set up our portfolio.
Yeah.
Does that
It does make sense. The next question was, how do you then get over that barrier? Is it just accepting that this 20% you've allocated based on let's say the Coke theory, might not come to fruition, but if it does, then awesome, you were ahead of it. What is that aha moment that someone might have to kind of get over that, if it is a struggle to kind of have that split? Because it's two different ways of thinking, really.
It is, and it is a tough thing to do.
Yeah.
I know it's like that image. I don't know if it's got a name, but you know that image where you look at it and it either looks like a mug or a cup. A
I know
chalice.
the types of image.
Or two faces facing each other.
Yeah,
right?
there's a duck and a rabbit one that's very
Exactly.
popular.
Yeah.
Yeah.
And you can't see both at the same time.
No.
You can only see one or the other.
Yeah.
And it requires a certain type of cognitive dissonance,
Yeah.
like a certain type of partitioning of your mental space.
Yeah.
And it is very difficult to do.
Yeah.
Like, as evidenced by any opinion that you can have.
Yeah.
That you can see on social media.
Yeah.
It's very difficult to find people who can genuinely understand the other side of the equation or argument. And so how to get to that, though, right? Like how to actually...
Yeah.
It, unfortunately, it just requires a lot or uncomfort.
Okay. There's growth.
Discomfort is a better word, isn't it?
Yeah, there's
discomfort.
Peter says to us or me quite often that there's growth in the discomfort, right? Yeah. There's a lot of growth that can occur there.
Yeah, and I think we've become quite good at seeking out comfort in the last 5 years or so.
Yeah, and some stability. Hey, there's so much that happens that's outside of our control. And this is a very sensitive topic, right? It's finances, it's future, it's your investments, it's your security. So there's an extra layer of sensitivity there. Yeah.
That's right, because it's a token of your human time and energy.
Yes, yeah.
This money.
Yeah.
And I know how hard it was to get this.
Yeah.
I don't want to put it into this wacky idea that maybe AI will make the cost of everything infinitely cheaper in the future.
Yeah.
Yeah, I kind of get it, but what if?
Yeah, what if it doesn't? Yeah.
Or I don't want to take this money and put it towards this crypto thing when I've heard of all these scams and people losing money, and surely Bitcoin is just as crap as all the other ones, right?
Yeah.
Or I don't want to put this money into property because for the last 4 years, we've seen nothing but declines.
Yeah.
In terms of real purchasing power, it's gone down by 40%, and it will never change.
Yeah.
You know?
Yeah, I went in with a biased mindset as well towards property, and it was, again, I think a large part of it was because of the way I was raised, because of the way I saw my dad build his wealth, and I went all in on a property, and I had big plans. It'll become a rental property. It's close to the hospital, this highway, that highway, train station, bus. Perfect investment, perfect. It's done nothing but depreciate for the last 4 years, and because of that,
So it's a consistent performer.
consistently performing sideways at a slight decline. Yeah. And because of that, I've realized, and I was paying down the mortgage quicker. I was doing everything right, as we'd say. But zero diversification. There wasn't anything else. And we've had, recently we had one of the best 10-day returns in the stock market, right? So
That's right.
that also was a big eye opener for me as well, where I'd put everything into one asset class, property, because I knew it was something that would work. But also thinking it is a long-term investment, but your day-to-day cash flow is such an important part of your budget. It's of your household. Your budget is so important. It's your dining out. It's your date night. It's everything. You need this. So my perception has changed quite a lot, and that's why I resonate really well with a lot of what you're saying. And you mentioned something earlier as well. You kind of continue to do your podcast, even though if you might sound like a crazy person, but you put a lot of information out there, and it's again, for me, I think it's really good information. But do you think that in that space that there's enough being done to, let's say, talk about the alternatives, or is a lot of it still quite crowded with getting the views, getting the listens?
Yeah, that's a really good question. And I think that goes down to the core reason why a lot of us can't genuinely see the other side of the equation.
Yeah.
Because we're so afraid to think differently because people won't listen to us.
Yeah, yeah.
Right? And that's kind of what I've taken into my podcast, is that attitude that I'm not going to comply with that.
Yeah. Okay.
I'm not going to be told to think a certain thing.
Yeah.
I'm going to think what I'm going to think. And if you don't like it, then you don't like it. That's not actually my problem. I'm just being a human.
Yeah.
And you should probably try and do the same.
Yeah.
You know what I mean? Like that, because that's what's going to protect you in the future, is your ability to stay human when everything digitizes and everything becomes so diversified that you don't even know what you're doing anymore.
Yeah.
And that day is coming. And so I think that if, just going back a second though, you mentioned the property thing and your experience with that, and it was this one asset. And I think, like, my personal view on a concentrated wealth building strategy through property is still, in my view, that it's a good strategy in that it is concentrated.
Yeah.
And I think when you have a long time frame to go, especially if you're investing according to a firm conviction that you think long term it's still a good idea, concentration is good.
Yeah, okay.
It's not bad.
Yeah.
It's just diverse centration is better. In other words, doing more than one concentrated thing is a good idea.
Yeah.
So maybe it's property, it's a portfolio of US tech stocks, and it's Bitcoin, right?
Yeah. Yeah.
Those are three pillars. And hey, if one of them really takes off,
Yeah. You're good to go.
you're not going to care about the others.
Yeah.
Whereas I think over time, the more diversification we do, which by the way comes from an industry that makes money by pushing diversification.
Yes, it does.
See also S&P 500 and all the index funds that are created off the back of that.
Yeah.
Again, nothing wrong with that. It's a good way to save money and preserve its purchasing power. But the more diversification you employ, the closer you get to matching the rate at which our currency loses value by, which is roughly around the long-term return of the S&P 500.
Oh, okay.
So I think when a lot of people are investing in pure diversified strategies, all they're really doing is matching the rate at which their currency is losing purchasing power by.
Yeah.
It's compounding.
Yeah.
So you still can build wealth that way.
Yeah.
But that's what it is. So I just wanted to kind of get that sorted out first before answering your question, which I'm really sorry, Kyle. I totally forgot what it was.
No, it's okay. But now to go back to where you were there as well. In practice, right? Because let's say my property is $1 million. It's not, but let's say it's $1 million, and let's say I've got $800,000 mortgage, recent purchase, 20% deposit. Now I view that it's not necessarily an asset, and we know that. But if we started renting out rooms and this and that, we can start generating something out of it. In practice, diversification doesn't happen at once, right? It's now that I've, let's say, got $200,000 worth of equity in the home, and then I say, actually, now I want to have a 50-50 split between in stocks and property. Then over the next 5 years, let's say I start investing and magically I've got $200,000 in a kernel fund. Is that generally what you see happen in practice as well with clients when you're building portfolios?
When people are doing it themselves, that's a really common way that I see it, is that they'll get their property and then they'll start, like, assuming they've done their budget, they've got their cash flow sorted, they've built an emergency fund.
Yeah.
They'll then start dollar cost averaging into an index fund.
Yeah.
So for the audience, right, dollar cost averaging, you're taking a set amount every time you get paid,
Yeah.
and you're buying an investment no matter what the price of that investment
Yeah.
is, right? And then you're averaging out what the actual cost of that investment is over time. But they're usually doing it through index funds
Yeah.
or ETFs that hold a lot of investments in one go.
Yeah.
It's a really low cost, efficient way to get exposure to a diversified investment strategy.
Yeah.
Where, like, you can't get much more diversified than 500 investments in one go, right?
Yeah. Yeah.
Well, you can, but it's a great way to do it. The issue is that the younger you are and the longer you have to go, the more you can bounce back
Yeah.
from higher risk investment strategies.
Yeah.
And a higher risk investment strategy, or one of the best examples I can think of, is a more concentrated investment strategy.
Okay.
And that's where maybe instead of 500 shares through one index fund, maybe you do just a little bit of research, and
Yeah.
it's so much easier now with AI.
Yeah.
And you can build a portfolio of, say, I'm just putting it out there, 10 stocks.
Yeah. Yeah.
Right? And you really have no excuses these days to not do a little bit of work using Claude or ChatGPT.
Yeah.
You know, tell it your version of the future. What are the 10 best stocks for me to invest in if I believe this is the future when I'm 65?
Yeah. Okay. Yeah.
Simple.
Yeah.
That's a way more concentrated strategy, which will be way more volatile. You'll see
Yeah.
the price go up and down of that portfolio a lot more
Yes.
significantly. But if you're young and if you realize and you really believe that I'm locking up this money for 40 years or more, do it.
Yeah.
Don't put it in towards like what effectively is a savings account.
Yeah. It deserves the research and the attention into it, right?
Yeah. And I should say it's not a savings account when you invest, of course.
Yeah.
A savings account should be, don't get me started on that one, actually. But yeah, I think that a lot of us, we fall into the marketing funnel of a lot of these big providers and small startups that are genuinely doing good things by providing low cost exposure to diversified investment strategies, but they're doing it, in my view, using a disingenuous interpretation of data.
Okay.
If that makes sense. So you take an actively managed fund, which is higher cost because there's research and analysts and people doing stuff. And then you take a passively managed index fund where either an algorithm or a set formula is used and you invest no matter what.
Yes.
The passive strategy will almost always win based on that exact same actively managed strategy.
Yes.
The conclusion drawn from that, therefore, is that any active investment strategy is a waste of time. Therefore, don't do it. Therefore, always buy our fund.
Yeah, unless there is such a case where the active manager has been able to outperform by doing their own thing. But there's been a lot of articles recently where that has certainly not been the case.
It's rare. I've got somebody coming on the podcast next week, I think it is, one of the fund providers that we use, which is an actively managed fund where they have consistently outperformed the index over time. And that's exactly what I'm trying to grill them on.
Yes.
And again, I actually think there's a place for passive investing and active investing. Not necessarily at the fund level, though. At the individual investor level. Right? So that's where you, as the investor, can say, I'm going to have a little bit of an active fund and a little bit of a passive fund. I'm going to own this investment directly, whether it's property or something else. And I'm going to have a stake in this. Right? Or I'm going to change it when I see these things occur in the world. And I'm not going to change it if I see these things occur in the world. So that's an active strategy, and you might have passive tools. So I think we've been sold. Well, I know we've been sold, but I think we've bought, as investors, a lot of the marketing hype, which, you know, it's good in that it's helped people learn.
Yeah.
But unfortunately, it's just disingenuous.
Yes.
It's not true for everybody all the time.
I've had this conversation before with some KiwiSaver providers actually, where so I've got some investments with Kernel, very small, but just low fees, decent returns, and I'm happy with that. So that's kind of where I've gone. But I've got my KiwiSaver with an active manager, right? So I've got those two. But obviously, when you do see these promotions and when you do see these things going on and giveaways and events and all sorts of things, right? It's funded by our future retirement, essentially, whether it be the management fees or an admin fee or something. It is money that's intended for retirement, right? And now it's gone towards promotions. And the counter argument, and I get it and I appreciate it, is that, well, it is access, it is getting more people. We are reaching more people. We are getting more advice out there. And in turn, you could very easily argue, does improve the financial situation as a whole.
Yeah.
It just comes at an expense. So I think it's interesting to try and find that balance between the two. Or is it just a necessary evil, basically, that it's got its benefit, but we have to pay for it today? Yeah.
There's a lot to that. Right?
Yeah.
Like the cynical part of me wants to say, and it is just the cynical part of me. It's not really necessarily what I think. A lot of investing is basically a pyramid scheme.
Yeah.
Right?
We're going to have to dig into that. Yeah.
Yeah. Because all we're doing right now on the podcast is we're talking about the benefits of building wealth, right?
Yeah.
Maybe not specifically today, but
Yeah.
that's kind of what we're doing. We're talking about, hey, it's good to invest.
Yeah.
It's good to work hard.
True. Yeah. True.
Manage your money well. Carve off a little bit of the surplus.
Yeah.
Put it towards your future world, right? Yeah. But where does that money go? Well, it goes into assets that, as we've already covered, somewhat restricted in supply. So what happens when you have more money chasing finite supply of something? The price goes up. So one of the reasons why our investments increase in value is because of currency debasement. But more accurately, that means more people have access to more money. And if they've got their stuff together, they'll put it into investments, which bids up the price for investments.
Yeah, okay.
That is a pyramid scheme.
I see,
right?
okay.
And so the existing bag holders get paid out by those that want to check out. And just look at property over the next 10 years as baby boomers transfer their wealth, which currently sits in property, to the next generation.
Yeah.
You know, we are exit liquidity,
Yeah.
right? Like we are the ones that are hopefully
Yeah.
going to pay a premium for the property so they can get out. But we're doing it because we make more money.
Yeah.
Or because interest rates are lower and we can access more debt to give to those boomers so they can spend it on their expensive healthcare as they die.
Yeah.
Right. So hey, this is how the money world works, right? But we are basically promoting a Ponzi scheme.
Okay.
Well, it's not a Ponzi scheme because I think a Ponzi scheme needs an actual puppet master, right?
Yeah. I get you.
But it is like this kind of tacit pyramid scheme, isn't it?
It's a very interesting way of thinking about it. Again, it would be the second big shift that you've provided me in my own little finance journey now.
Yeah, I hope it hasn't taken away some of the magic of investing to anyone.
No. I've learned a lot of lessons over the years in terms of where to invest and have some patience. The main thing I've learned is to have some patience and trust the professionals, trust the research, trust the data, trust what it shows. Find your belief in terms of where you want it to go, where you think it's going, as you said, and just stay the course. And that's kind of where I am at the moment. And if it works, it works. If it doesn't, maybe we're all screwed as a collective. But if it works, then great. Those who have put in the effort will benefit from it from in the future. If you could go back and tell younger Darcy something, not lottery numbers, not investing Bitcoin, because that's hindsight, and we all kind of have something there. But a philosophy or a way of thinking. What's one thing that you wished as young Darcy would have done differently back then that would benefit you today?
Oh, great question. Go harder, go sooner.
Okay.
I didn't really have a control over going sooner, so I probably wouldn't say go sooner. I couldn't have done anything faster than what I did, but go harder.
Yeah.
And for me, that meant work harder sooner. I've always been what I think is a hard worker, but when I was building my first business, probably in the first few years, I could have put more into it.
Okay.
Right?
Yeah.
I was younger. I didn't have kids. I could have put in way more hours.
Yeah.
And I was onto a good thing.
Yeah.
I could have probably done better, right? So that's one part of it. But also, when my wife and I bought our first home, we paid, I think it was $289,500. Like amazingly low price by today's standard, right?
Yeah.
Right across the fence was another property for just under $500,000.
Okay.
And it was one extra bedroom. It was a standalone rather than a small little unit.
Yeah.
We should have gone harder. We had the bank funding approved to do
Oh, okay.
both, right? I chose the safer option.
Oh, okay. Okay.
We were younger. My business was still early stage, but we had 2 incomes and no kids. There was really no reason why I should have doubted what our incomes would be growing by.
Okay.
I should have known that.
Yeah.
Yes, banks could have increased interest rates, war, all these macro geopolitical things.
Yeah.
They've always been with us, though.
Yeah.
So you can immediately remove all that.
Yeah. Yeah.
What can you control? Well,
Yeah.
I can control how hard I work. I can do the best we can every day. And if everything looks good, why am I throttling my potential?
Yeah.
Right.
Okay.
So that is the one thing that I probably regret in terms of our early on our financial decision.
Yeah.
Is that we should have bought that property across the fence, because today we still own our $289,500
Oh, wow.
property.
Yeah.
Which is probably worth $1 million.
Yeah.
Right.
Cool.
Across the fence, though, it's worth probably 2.
Yeah. Okay. Yeah.
So when you think about the capital gains there,
yeah.
I just dropped like a lazy $1 million or $750,000 on the table, right?
Yeah. Okay.
That's what that's cost me over 20 years.
Yeah.
So the price of being conservative today, if you're a young person, magnifies over time, along with the regret that you feel.
Okay. Yeah.
So going harder
Yeah.
sooner
Yeah.
is so important, I think, and that's the one message I would give my kids.
Yeah.
As well as any client that I know who's just starting out. Take your biggest step first. Yeah.
And how would you apply not over leveraging yourself in that situation? I always try and think back to, I need to remember what I was thinking at the time I made a decision, especially for investments, right? You invest today, tomorrow you might know something, right? Yeah. So how would you then apply not over leveraging yourself in that situation? Because that may have been part of your decision back then. It's safer or whatever it might have been. How would you, I don't know if quantify is the right word, but how would you kind of quantify that discussion with yourself?
And like I'm simplifying and generalizing all over the show. Like if you pushed yourself really hard in 2021, right, and you bought your first home and the market drops by whatever
40% in some places,
especially adjusting for purchasing power, like real loss of purchasing power. That's terrible, right?
Yeah.
But again, like we have to kind of look at the future with our big boy pants on, right? We can't force the future or force the world into a version that we want. That we have to take
responsibility, right?
Yeah, absolutely. And which means that you're going to take a hit. But what I'm saying is, from a relative basis, like you got to take that gutsy move when you're young.
Yeah.
Because even if you were 28 years old when you bought your first home in 2021, and you're underwater by 30 to 40%, imagine if you did that when you were 60.
Yeah. Okay. Yeah.
Because I see people all the time. Cramming for finals, right?
Yeah.
They know they've got a short runway,
but
they don't know enough about where they should put their money, so they put it straight into property. They buy a unit off the plan, settles in 2 years' time.
Yeah.
Bank criteria changes. They've lost their job because they've been displaced by a AI chatbot. They can't settle. There's so many risks. But that's what older people do. They should have done that when they're younger.
Okay.
It's not going to work out for everybody. But if you want to have a decent crack at making it work in the future, gotta balls up early. You know,
take the risks.
Go
for it.
And I don't mean like purposely make a mistake, but you really do have to kind of give it a crack.
Well, you've got time to make up for it, to recover if something happens. And has anything recently occurred, or that you've seen, or a perspective shift in your mind changed the way you kind of view investments, or changed the way you view finances?
Lately, you mean, or
somewhat recently, or something. I guess a consequential event that has happened for me. As I've shared, it was my property. I went all in, and it wasn't until the practice of actually seeing it decline changed, where I wasn't much interested in investments. I wasn't much interested in anything outside of property. But seeing it not perform very well for me has completely changed the way I think about investments, and the way I need to diversify now, to the point where I've taken action to slowly start investing. Has anything been because you would be so exposed to this every day, so you'd have so much information coming in all the time. Has any major thing happened that has kind of changed or shifted your perspective?
Yeah, I guess you could say my perspective never sits. That's the problem, is that it's like the structures that I put in place, or the investment strategy that we put in place, has to be fixed, because my mind is always kind of wanting to move beyond
Oh,
that.
okay. Yeah.
And so the one thing I guess you could say that we did recently, which came off the back of a bit of a mindset shift,
Yeah.
was I concentrated where my income came from, rather than owning a business with multiple streams of income.
Okay.
Traded that for a business with only a couple.
Okay. Yeah.
And so I concentrated my income, but at the same time, we're diversifying more in terms of our existing wealth.
Okay. Yeah.
And it's an interesting kind of thought experiment, right? Because when you're younger, you ideally should be diversifying your income source,
Yeah. Yeah.
and you should be concentrating your investment strategy.
Yeah.
That's kind of what I'm thinking now in hindsight.
Yeah.
Is a really good idea. I can't say that I had that knowledge back then.
Yeah.
But that's kind of what I would think now. So I'm de-risking in one way, and risking up in another, or like I'm risk on in another way.
Okay.
And I think it's just something to do with the inflow of financial resource coming in, and then where you store that
Yeah.
probably needs to change over time as you get closer.
Yeah.
Like I'm about 15, 20 years or so away from probably drawing down on
Yeah.
our wealth. And it's progressively more important to de-risk, in my
Yes.
view.
Yeah.
And so the way that I'm doing that is I'm trying to rebalance my portfolio, which is still very property centric.
Okay.
And I'm not trying to sell,
Yeah.
just because it's just horrible timing. I think any property holder would say that.
Yeah.
I need to get at least past the 3 years that everybody else is probably thinking to sell in.
Yeah. Yeah.
And then the idea is to put that to work in the other pillars that
Yeah,
we've been
okay.
building over time already. And, that will be more diversified. And so that's just to cater for a more uncertain world. So we've
Yeah.
already got those things I'm pretty happy with what I've chosen.
Yeah.
Always kind of thinking about things on the edge. So I've got not a shares account, a hatch account, which comprises of it's probably more my short-term tactical portfolio, anything less than 5 years.
Yeah.
So that's where I'm bringing in any sort of thematic change that I might see coming.
Okay.
So
Yeah.
a shift to energy, shift to defense.
Yeah.
I'm not saying that that's what I'm doing now.
EV batteries. Yeah.
Yeah, that's
Yeah.
right. Yeah. Solar technology and
Yeah.
AI chips and all that sort of stuff. I'll kind of do a bit of research, and if I'm happy with the theme or
Yeah.
the investments, then I've got a way
Incorporate
that
it, yeah.
I'll incorporate that, and I'll get rid of the old one.
Oh, okay. Okay.
But it's not necessarily about getting a good investment return. It's probably a little bit of education.
Yeah. Yeah.
Probably a lot of education, to be honest. But yeah, so there's always this kind of new blood that I'm trying to bring in, but I'm
Yeah.
doing it in a way which is, again, it's that 80-20.
Yeah.
That's in that 20% component.
Yeah.
Right? Where you're just thinking, well, what's bits of the old that we're going to see again?
Yeah.
What's bits of the future that we might have seen that maybe people are discounting?
Yeah.
Right?
Yeah.
There's no NFTs in there.
Yeah.
But there are things that maybe others haven't seen yet.
Yeah. Yeah.
Yeah.
And you threw me off a little bit with the NFTs. I was so hopeful. I had
Hey,
three.
we all were. Yeah.
I had three. I think I maybe spent $200 on them, and I don't even know. I can't even log into the platform
Right.
anymore to get them. But I certainly fell for the hype of it. And again, that also kind of led to just find what you want, invest in it, and trust that this is what will happen, and just kind of keep going for it. So that's all helped a lot. Simplifying has been my theme for this year, really. Just simplify the process, simplify the budget, simplify the investing, simplify we have auto investments, or we have auto payments going off, and I've just simplified everything. Sure. And I've seen much more progression that way than trying to apply it. I think that if you start researching, and that was the question earlier on is around the education of it.
Sure.
There's so much out there. There's so much education. And if you look for property as the holy grail, you will find that. If you look for index funds as the holy grail, you will find that. And whichever one you feed is the one that wins ultimately. So it is very hard to as you say, it is very hard to have, let's say, a belief and stick to that, right? As you stick to the podcast, you keep putting the education out there.
Yeah.
It is a very difficult thing to do in today's times when we're just so exposed to everything that's out there. But I thank you very, very much for coming on. For anyone who's looking for you, anyone who wants to book a session with you, or anyone who wants to reach out or learn more, where can they do that?
Cool. radicalinvestment.co.nz is probably the best place to go.
Yep.
Or just Google my name, Darcy Ungaro.
Yeah.
Yeah, available where all good search engines are available.
Yeah.
Yeah.
Darcy, thank you so much. I really appreciate it.
Cool. Thanks, Kyle.